Good afternoon, everyone, and welcome to the Colliers webinar for the second half of 2024. My name is Anti, and I will be your host for today's session. Before we jump into our exciting agenda, let's quickly cover some important guidelines. So to ensure a seamless experience, we have disabled audio and video for all participants except for our panelists. And this helps minimize any background noise. This session is being recorded. If you miss any part of it, don't worry. We'll send you the recording version and also presentation slides tomorrow afternoon. You will see QR codes in the virtual background of our speakers and at the end of the session. Scan this to save contact information or to download our reports and insights. We welcome your questions and insights. Please type them in the question box. If we run out of time, we will follow up to your questions via email. If you need any help regarding the webinar settings, our webinar host is here to assist. Just type your queries in the chat box. Your feedback is very important to us. We will send you a survey link along with the recording tomorrow. Please take a moment to share your thoughts. Now, let me introduce you to our esteemed speakers who will be sharing their valuable insights today. First, we have Bapak Mike Broomell, our Managing Director and also the Head of Capital Markets and Investment Services. We also have Bapak Ferry Salanto as the Head of Research. From Office Services, we have Bapak Bagus Adikusumo as the Head of Office Services. We also have Bapak Halsema as the Head of Retail Services. Bapak Freddy Hidayat is here on behalf of Bapak Ivan Munansa to present the industrial and logistics market. Ibu Es-sinaga as the head of residential services, and also Bapak Satria as the head of hospitality services. Our first speaker, Bapak Mike Broomell, will kick things off by discussing the latest trends in the commercial real estate landscape in Indonesia. Pak Mike, the floor is yours.
Okay, thank you, Auntie. I'd like to thank you for joining the seminar today, or the webinar. We weren't quite sure what the attendance might be, considering it's about a week from the Christmas New Year holiday for many of you. And I think we are about 50% above the attendance that we had earlier this year. So it looks like there's a lot of interest in what's happening on the investment side of things and the real estate market. I wanted to start off with some overall view of the economy as we hear it from investors that we talk to, and some of the factors that they're considering that might be of interest to you to understand. The first chart here, it talks about the prime lending rates for the different Asian markets, and we've put that side by side with the cap rates, or the returns that investors would typically be expected to obtain in those same markets. And it's quite interesting. One of the issues for Indonesia, which is highlighted here, has been that interest rates are relatively high. We see that interest rates in the Philippines and in Vietnam are even higher, and the same with India. But usually investors would like to borrow as much as possible, and they'd like to pay as low of an interest rate as possible, and they want to pay a lower interest rate than they can get on the return on their investment. So you'll see that Australia, for example, interest rate, prime lending rate is around 3%, whereas the cap rates for office and industrial in Australia are much higher. And that's one of the reasons we see a lot of interest now in the Australian market. China is not that much different, except I think most people are very concerned about what's happening with the economy there, and it is a controlled economy. So we don't see the interest there. In fact, we see a lot of investment coming out of China, which is what we'll talk about in a second. But Indonesia rates, typically the capitalization rates have historically been lower than interest rates. And that's been one of the obstacles for a lot of investors coming into the market. Although some banks are willing to loan at much lower rates than are shown here. We can go to the next slide. I wanted to also talk a little bit about taxes, because that's an issue when investors are considering coming into Indonesia. We've been hearing about PPN being increased to 12% at the beginning of next year. And it looks now like the Indonesian government has said that 12% will be limited to luxury goods, which is good, because at 11%, as you can see here, we already have a higher VAT than most every country shown in this map, except for the Philippines. And we would have ended up matching the Philippines if we had gone 12% across the board. And that is a concern for investors, both from the standpoint of how it affects the economy, and also taxes that have to be paid on the purchase of real estate, which obviously negatively affects the real estate market. Next slide. Another factor affecting the market, and this is good news, is that there has been a move recently to eliminate not only the VAT or PPN on the sale of residential properties, but also the BPHTB. That was announced by Pak Prabowo's brother Hashim, and for the in general, we're not quite sure how it applies, but already there's a BPHTB exception for houses that are priced under 180 million rupiah. So this has been an impediment to the market in general, and I think obviously the government has realized that, so they've eliminated these taxes. As you can imagine, 16% tax when you purchase a property tends to discourage you from making such purchases. So unfortunately, this is still an issue with commercial property in Indonesia. And one of the questions, in fact, we had that were presented in advance of the webinar was about the REIT market, or the what we call DIRE, Dana Investasi Real Estate. And for property acquisitions, still the BPHTB of 5%, the VAT still applies, although eventually you get the 11% back, but there's a time value for money. So this has been another issue that we've had to overcome when investors are coming in, and is a reason why a lot of people that we've talked to about DIRE or REITs are not that interested in setting up REITs here in Indonesia. I think that would be an excellent way to help to stimulate the market, and we've tried where we can to encourage the government to consider waiving PPN and BPHTB on commercial acquisitions as well. Next slide. Now, one of the positive things for us is what's entitled here in Compass as the Trump effect. The U.S. government, the new president, is threatening quite a few tariffs on China, and as a result, we're seeing a number of Chinese companies that are looking at setting up operations here in Indonesia, because if they export to the U.S. from Indonesia, they can avoid these tariffs. And imports from Mexico and Canada, Trump has threatened 25% tariffs, but in the case of China, he's threatened 35% tariffs in general. and some tariffs are higher depending on the product. So a lot of Chinese companies are looking at setting up operations here, partially to avoid the U.S. tariffs. But in addition, if I can go to the next slide, there's also things that the Indonesian government has done to encourage investment from China. The Indonesian government itself has put tariffs on last July of 100 to 200% on some Chinese products that are mentioned here, including footwear, clothing, textiles, cosmetics, ceramics. And I think as many of you know, there's also quotas that are being put on, or in some cases, restrictions on imports, for example, with iPhone 16. So as a result of this, more and more companies that want to do business and sell product in Indonesia are looking at setting up factories here. And so we're seeing a lot of interest from Chinese companies. Almost every day we seem to get a call from one that is looking to set something up here. So especially for the industrial and logistics market, this is a very good development. Next. Just overall, and my colleagues will talk about a number of these in more detail, but as I just indicated, the industrial logistics market seems to be very strong. We see, in some cases, some portfolios of logistics properties that have come on the market or on the market. So that seems to be one of the preferred sectors. We're seeing a lot of interest in data centers, especially a structure where an investor can come in on the property company without taking the risk of a data center. So it's almost like a build-to-suit scenario. But it takes people with deep pockets because data centers cost a lot of money. So I think that's been one of the dilemmas here. Although people would like to invest in data centers, their ability to come up with the amount of money that it would take is somewhat limited. And so we see a lot of foreign investment in looking for opportunities to invest in data centers. Landed housing, we've seen a lot of developers that have previously built apartments that are no longer interested in doing that, but have focused instead on landed housing development. And I think that seems to be strong, especially with the waiver of the VAT or PPN. And I think that we would imagine will continue. Even with retail, we're seeing an interest on part of retailers that are wanting to come into the market. And that seems to have picked up quite well, as in addition to these other sectors. For the second row, we have some sectors that I put in yellow as opposed to blue, just because I see opportunity in them, but they're a little bit riskier. We see interest in hotels, especially in Bali. It seems to be a very strong market, but we also are hearing about a number of hotel portfolios that banks have that are distressed, and so that is a little bit of a caution there. But I think in general we see there's some good opportunities to purchase at good prices, especially with the bank putting pressure on the hotel owners. Office is somewhat similar. The office market, as most people know, is quite bad. The occupancy is very low. The rates are very low. And as a result, the prices of properties are quite low. And we're seeing and know about some acquisitions where some developers or some owners are taking substantial write-offs from the amount that they initially invested. Some of which I'm not able to talk about at this time, but we know about those, and we've known properties on the market that are selling for very attractive prices. So to the extent that somebody could buy a hotel property and they're not taking the leasing risk because it's already pre-leased or there's a commitment of tenants for the next 2 or 3 years, I think there could be some very attractive opportunities there to carry you until the market turns around. Apartments also, the service apartments I like because you have income coming in. there are a number of apartments that have not sold, and the apartment developers would like to unload, but you take the risk of lack of income if you purchase those. And it may take a while for the apartment market for sale to come back around. Senior living, we're starting to see some interest in senior living. It's more than I've seen in quite a while here, especially in Bali, where it's an attractive place for folks, not only potentially Indonesians, but others like Australians, for example, to move to Bali and retire in a place like Bali. So I think there may be some, for those that are interested in looking at investing in asset classes that are a little bit outside the box, that might be one that's interesting to explore. And then finally, on land, I think there's some, again, very attractive opportunities. I used to be a banker in my earlier career, and I know that land is one of the worst kind of assets to have if you have that collateralizing a loan, because there's no income coming off the land. But for those that have patient money, that are looking for attractive deals, there's some good land opportunities where people need cash, and they are willing to sell some of the land that they may have held for many years, but they are willing now to sell because they need the cash and they can sell at very attractive prices. So anyway, that's a broad overview of the market. And I will leave it to my colleagues to go into more detail on the different asset classes. So thank you all. Have a great Christmas and Happy New Year.
Thank you, Pak Mike, for the presentation. Now, next we'll dive into the office sector. Bapak Ferry Salanto, as our head of research, will provide an overview of the current office market, followed by insights from Bapak Bagus Adikusumo as the head of office services. Over to you, Pak Ferry and Pak Bagus.
Okay, thank you, Auntie. Good afternoon, all. And thank you for attending our webinars here. So starting with office sector, and here we have a chart here. Let's take a look at the development of the office sector in 2024. And based on the chart on the left, we can see that the annual supply growth has started to be moderate. And in 2024, the total supply was much smaller compared to 2023, when it reached over 400,000 square meter. And in contrast, for 2024, only around 100,000 square meter of new supply came into the market. Looking ahead, this moderate growth trend is expected to continue, averaging below 100,000 square meter per year until 2028. And this is, we think, a good news because it helps stabilize the performance of the office sector in Jakarta, which has been under pressure due to the oversupply. And both in the CBD and non-CBD area, the incoming supply over the next 3 or 4 years is projected to remain manageable. And this creates opportunity for the office sector to gradually improve its performance, which is a positive indicator even though the sector is not yet fully stable. Next slide, please. Okay. This is the performance of office sector up to 2023. As the data shows, the performance dropped significantly during the pandemic, with the occupancy rate declining sharply in 2023. But entering 2024, particularly in the third quarter, we have started to see signs of recovery. And by the end of 2024, occupancy rates are expected to remain relatively stable with minor adjustment. Looking at the chart in the middle, occupancy rate in the CBD areas are relatively steady, especially in key areas like Sudirman, Tamrin, Rasuna Said, and Satria, where occupancy reaches around 80%. And high-grade buildings such as Grade A and Premium Office also saw decent performance. However, it's worth noting that the office in the Simatupang and South Jakarta area tends to perform better than in other locations. East Jakarta recorded higher occupancy rates in the previous year, although the overall occupancy, the overall supply in that area remains limited. And specifically, the occupancy rate for Grade A buildings has slightly decreased compared to last year, and this is due to the addition of new supply, which has affected the overall balance. Next slide, please. Okay. In terms of rental prices, the trend closely mirrors the occupancy rate. As shown in the chart on the left, there was a significant drop in asking rent in 2023, which has continued into 2024. However, there is a hope for slight improvement by the end of this year. This is mainly due to the entry of new office spaces with price higher, which is expected to raise the overall average rent. In the middle chart, as you can see, we can see a wide range of rental prices within the CBD. For instance, in Sudirman, there is a noticeable gap between premium buildings and those with lower quality. Despite this, the average rent in Sudirman remains the highest compared to other areas. And as expected, building quality plays a key role. You can refer to the right chart. Higher quality buildings, like those in the premium category, command high rents. But on the other hand, lower grade buildings, such as grade C, have more affordable rents. And outside the CBD, rental prices are generally similar across areas, except for East Jakarta, where rents are lower due to the lower building quality in that region. Next slide. Okay. Finally, let's look at the strata title office prices here. This chart shows a significant prices variations. For example, in Sudirman, some buildings are offered at under 40 million per square meter, while the others in prime location are priced close to 100 million rupiah per square meter. Overall, the prices have been relatively stable with little fluctuation. And looking forward, we don't expect significant price increase in the near future. Okay, thank you. And I'll give the next session to Pak Bagus.
Thank you, Pak Ferry. Good afternoon, everyone. Thank you for joining our webinar today. Despite what has been mentioned by Pak Mike and Pak Ferry about the office market condition, 2023 and continue to 2024, we see a lot of companies are actually remains positive about their business, and the condition of the economy also help them make the decision to relocate or expand. And that has been proven by the fact that towards the end of the year, right after the inauguration of the new president, we witnessed a lot of companies that have been postponed in their planning to expand. They started making inquiries and then looking ahead to expand and relocate to a new building, and hopefully all to be concluded in the next year. Economic stability has also improved after the inauguration. Economic stability has also improved the confidence of the companies. So we hope to see this rise of the office inquiries to be continued next year, because we project that in 2025, as if you notice the slide that Pak Ferry has shared with you, there will not be new supply in CBD area and only limited supply in 2026. So that limited supply will help the overall office market performance, because we expect the demand will grow, because inquiries is already many towards the end of the year. So we hope to see the more inquiries next year, and then it will balance between supply and demand, and also increase the occupancy rate and also the rental rate. Next. The tenants market, we call it. So market of the office market condition right now still in favor of the tenants, slash occupiers and also buyers to certain degrees. And that is also understandable because we still have oversupply condition. And then office space in the CBD, because of the limited supply we project in 2025 and 2026, that will also balance between supply and demand. That will help the recovery of the office market. Supply limited and the demand is growing up. So hopefully things will catch up very soon. And then about lease period is still the same. Normal lease period, most of the tenants, when they relocate and sign up the lease, they're looking at 3 to 5 years. Rarely we see 7 or 10 years, just like in the past, in the good old days. So mostly people are companies signing up 3 to 5 years. Next. So what are the opportunities for the landlords? Now, a lot of after the inauguration of the president is quite confident, and the whole economic team also quite confident that they will be able to achieve the GDP growth of 8% starting 2025 onward in the next 5 years. And then the correlation between GDP growth and office demand is quite strong. So when GDP growth can achieve 6, 7, or even 8%, that will help the significant improve of the demand for office space, while the supply is limited, at least in CBD in 2025 and 2026. And then, as Mike mentioned in the earlier stage, there is a trade issue between China and the US. Tariffs has been increased for any product from China. So we expect, we forecast that a lot of companies from China might want to move to Indonesia and start manufacture in Indonesia. So they will need to have an office space, mostly manufacturing, but they still have to open up the operation in CBD area and also in non-CBD area, depending on their business segment. At the same time, landlords will still continue to be flexible in order to secure tenants, because right now flexibilitas and accommodative from the landlord's perspective will help the tenant to decide which building they want to go to. And then more and more other companies as well, that they prefer to go to the space that is already fully fit out, or at least the space that can be furnished by the existing landlord. So that's still the appealing condition of the office situation. Next slide, please. Now, from the occupier's perspective, the part of the initiative ESG, a lot of multinational companies have become a mandatory to move to a green certified office building. Now, the good thing about the developers in Indonesia or Jakarta, in certain degrees, especially, most of the developers are aware of this, so they start applying to change their non-green certified office building to become green certified office building. And they usually work together with either Green Mark or Green Ship from Green Building Council Indonesia. So that will help occupiers to choose to go to the green certified building. Then the option is a lot in the market. And then, yes, because of the oversupply situation and tenants market, so tenants still having the opportunity of strong bargaining power with the current situation. So most of the occupiers moving to a much newer building and pay the same rent as they are paying right now in the current building, or pay slightly higher, which is still manageable. Now, another good news about companies when they relocate is capex. Now, capex oftentimes is become the major issue to move because the fit-out cost is not cheap. Now, the good thing is the more and more landlords in Jakarta right now don't mind to provide fit-out allowance amortized over the lease term. So you don't have to ask approval from their head office, which probably having their own problem with the current global uncertainty. So the local company here, so multinational companies in Indonesia could execute the movement without incurring capex and only pay the opex, and then that will be amortized over the lease term, and it will be added to the top of the agreed rent. So that will be the solution to some of the companies that we assisted. I think that will be all from the office sectors. Over to you, Andi.
Thank you, Pak Bagus and Pak Ferry, for the presentation on office sector. Now let's explore the retail sector. Again, Bapak Ferry Salanto will explaining the market condition on retails, and our head of retail services, Bapak Sander Halsema, will share his valuable insights on and opportunities on retail. Take it away, Pak Ferry and Pak Sander.
Okay. Thanks again, Auntie. Okay, let's discuss about the retail and or shopping center sector. Here we have chart that show the projection for shopping center supply up to 2026. In the top left section of the chart, it shows that in 2024, both Jakarta and Greater Jakarta area are expected to have additional supply, with an average area about 150 to 200,000 square meters. And details on the new supply can be read in our quarterly report, especially the third quarter report, which we have released months ago. Now, what is interesting to note here is that starting in 2025 and continuing through 2026, there will be no shopping center supply in Jakarta. All the additional supply during this period will come from Bodetabek area or outside Jakarta. And this supply situation is different from the office sector, where additional supply is often considered an issue. In the retail sector, moderate supply growth each year is not much of a concern. In fact, having no new supply for the next 2 years gives the retail sector an opportunity to improve its performance, particularly in terms of occupancy rates. Looking at the supply composition in Jakarta and Bodetabek, most of the supply in Jakarta consists of upper class shopping center, followed by mid to lower class mall, and the total cumulative supply or cumulative retail floor area, Jakarta still dominates, while in Bodetabek, the fastest growth is happening in Tangerang and Bekasi. And this is driven by rapid residential development in these two areas, which has spurred the growth of new shopping center. Next slide, please. Okay, now let's take a look at the occupancy performance. If we compare to last year, occupancy rate this year has remained relatively stable, though they haven't yet returned to the pre-pandemic level. But on the other hand, visitor traffic to shopping center has normalized. By the end of 2024, occupancy rates are expected to remain steady. In the chart on the top right, you can see occupancy rates for Jakarta and Bodetabek. And in the bottom left charts show occupancy rate by mall class. In the overall, high-end malls are performing better than mid to lower class mall. And this is because high-end mall are more dynamic and tend to adapt to market trends. And in contrast, mid to lower classes mall are relatively stagnant, which affect their occupancy and visitor performance. Next slide. Okay. And looking at the rental trends, rents have been relatively stable from last year to this year, but they still haven't returned to the pre-pandemic level. In Bodetabek area, rental rates remain steady with some hope for slight improvement by the end of the year, which could carry into the next year. However, we should anticipate the maintenance costs, which are expected to rise due to the adjustment in the minimum wages which has been announced by the government, and this will increase operational expenses. So maintenance costs will likely to be adjusted next year. Next slide. Okay. This is the range of mall rental cost in as of third quarter 2024. If you look at the rental range across different areas, Jakarta, of course, has the highest average rents, especially in the CBD, as malls in this area are dominated by mid to high-end shopping center. But outside the CBD and or in the Bodetabek area, rental rates are generally lower. A few popular malls in Tangerang and Bekasi have slightly higher rental rates compared to other areas in Bodetabek. As for the maintenance costs, the highest costs are found in the CBD, but because most of the malls in this area are high-end mall and with more expensive upkeep requirement. And in Bodetabek, maintenance costs are generally uniform and lower compared to Jakarta. That's all from me. I'll give it to Sander to continue. Thank you.
Thank you, Pak Ferry. And thank you everyone for joining today's webinar. Good afternoon. I think one of the major topics discussed within the retail market lately is, of course, the looming VAT increase, which Mike already elaborated a little bit about, from 11 to 12%, that is set to take effect on January 1st, 2025. This increase in VAT rate will make Indonesia, along with the Philippines, the country with the highest VAT rate in Southeast Asia. It has been long unclear if the Indonesian government will actually formalize the VAT increase, especially because major political figures in this country have made contradicting statements on this lately. And actually the hope was for it to be postponed, especially as spending power of Indonesian consumers has already been weakened and retail sales growth slowed to a 6-month low of only 8% in last October, down from 4.8% in September, according to the Bank of Indonesia. Late last week, however, President Prabowo has reportedly agreed to formalize the VAT increase, so it looks like it will happen. But as Mike stated, we're not quite sure yet on what product groups it will be implemented. Among the main criticizers of these plans are, of course, retailers and small business owners, as the VAT increase is expected to have serious implications on their sales, and as ultimately the consumers will feel the burden. The diminished purchase power of consumers will affect the total retail sales, obviously, while retail and the wholesale sectors are among the greatest contributors to Indonesia's GDP. And hence, this increase potentially has more serious implications on the country's overall economy. We will continue, of course, in the coming months to monitor the effect of this increase in the VAT on the overall retail market and the retail sales. Next slide, please. Despite the earlier mentioned slowdown in retail sales, there's still appetite among many retailers to open new stores. Especially we see demand from the F&B sector in Indonesia that has been strong, with overseas F&B operators entering this market and national brands expanding across the Jabodetabek region. According to our own study, the F&B sector accounted for 38% of new store openings in malls in Jabodetabek this year, followed by the fashion and entertainment categories. They also had pretty strong demand for new stores. Our study, which will be most likely published early next year, proves the shift within shopping malls towards a stronger focus on F&B and lifestyle, responding to modern-day consumers' demand. Also, I should say, luxury retailers continue to optimize their store networks despite slowing sales in Indonesia, but also in Asia as a whole. So they are evaluating their current store network, focusing on larger but less stores, and on revamping strong existing stores located in prime shopping centers. A good example here in Indonesia is obviously the Louis Vuitton store in Plaza Indonesia. They relocated within the mall, opening a whole new flagship store, doubling the size of its former store in Plaza Indonesia. As Pak Ferry explained earlier, Vacancy rates in premium and grade A shopping malls are strong, low. These malls continue to see high demand from retail categories and hence have a strong rents too, due to retailers' demand for prime real estate at also high traffic locations. If we look at lower grade malls, we see a very different picture, with these malls in many sub-regions in Jabodetabek suffering from weaker demand, higher vacancies, and also pressure on rents. Next slide, please. So what are the opportunities for landlords, and especially landlords, I would say, that have lower grade shopping centers? As mentioned earlier in the presentation, retailers are still expanding, but they continue to prefer higher grade shopping centers with very strong footfall. And I think the pandemic has been a huge contributor to retailers being a bit more risk averse in terms of their expansion. The demand for and rents in prime centers continues to be solid as a result. But like I said, the demand for middle segment malls has been a bit more sluggish. Owners in this middle segment are advised to conduct a review of their mall, invest in improving the shopping center's overall ambience, improve the consumer experience and the layout to attract retailers, but also to meet the modern day consumer needs, I would say. Popular features we see nowadays are outdoor space, natural light, green elements, and open spaces within the mall itself. I think consumers nowadays are looking for great experiences, and so it's important for mall owners to make sure the mall and its features are well positioned to attract retailers, the right retailers, and bring a good retail experience to their consumers. A good example in Jakarta of a mall that is currently undergoing a major overhaul is of course Plaza Semanggi, with a total redevelopment period of approximately 2 years, I think, and are really aiming to revitalize the mall and enhance the overall shopping experience for consumers, and of course, by doing that, attracting new retailers. Next slide, please. So if we look at opportunities for retailers, as space in premium and grade A shopping malls is limited in Jakarta area, and like Ferry also said, there's also not a lot of new malls being opened or under construction in Jakarta. It is recommended for retailers that already occupy space in these malls to try to renew their existing leases sooner. And new brands entering the Indonesian market, they struggle a bit to get space in premium and grade A shopping centers. These retailers could try to open pop-up stores and island space first at these assets so that consumers can get to know their brand, they get good visibility and exposure, and to also build a relationship with the respective landlord. If the brand, what we normally see at least, is well received by the Indonesian public, it is much more likely the brand will be prioritized by the landlords to open up in an actual unit. Another approach for these retailers could be to first open in shopping centers located in the wider Jabodetabek region or in Surabaya or Bali. These retailers should really look for a center that has a strong tenancy mix and strong traffic, or for assets that have just opened an extension of their initial mall, or malls that are either under renovation or just have been renovated. I think there's still for these retailers good opportunities available in Jabodetabek to enter this retail market here in Indonesia. So these are my short updates. If you have any questions, please let me know, and good holidays ahead. Thank you.
Thank you, Sander, and also thank you, Ferry. In our next session, we'll focus on the industrial and logistics sector. Ferry Salanto will again start the discussion, and Freddy Hidayat will present on behalf of Rifan Munansa. So, Ferry and Freddy, the stage is yours.
Okay, thanks again, Auntie. And okay, here we have a supply chart. And from this chart, we can see the availability of industrial land in Greater Jakarta area, and it shows the existing land, the remaining land, and potential area for development in each region. But we don't include data for Purwakarta and Subang yet. We are still consolidating the number because these two regions actually have significant industrial land stock since they are emerging areas being developed as new industrial hubs in the eastern part of Greater Jakarta. Next slide, please. Okay, if we look at the available land, Bekasi and Karawang, as you can see from the chart, have the largest stock. However, most of the land in this area has already been absorbed, and the remaining land is now quite limited, especially in Bogor and Tangerang, where stocks are very low. A few industrial estates in Bekasi, Serang, and Karawang still have some land available, but the numbers are not significant. In terms of development potential, Karawang has the largest available stock, particularly in newer area like those located in Transhexa Karawang. And this area actually serve as a relatively new industrial hub for compared to the older industrial area, where more established zones like those in Bekasi or East Karawang. Next slide. Okay, this slide shows an annual industrial land absorption data, which include both land sales and leases. Although leased land represent a smaller portion, the data still reveals some interesting trends. By the third quarter of 2024, as the end of this September, total land transactions were nearly on par with the annual figures from 2019, which was one of the strongest years for sales. But in fact, the 2024 year-to-date numbers have already surpassed the annual sales from 2020 to 2023 that indicate that the industrial sector is recovering and moving faster than other property sectors. Next slide, please. Okay, now let's look at the active sector driving this transaction. In 2024, and this is data for 2024 year to date, about 43% of the transaction came from the electric vehicle or EV industry. A major deal contributing to this growth was BYD's entry into the Subang Smartpolitan area, which significantly boosted the overall performance of industrial estate in Greater Jakarta area. But in the meantime, the data center sector, as you can see, which represent 11.1% there, is still growing, although not as strongly as before. Some industrial estates are continuing to attract and doing transaction with data center, but the number are now behind the booming EV automotive sector. In the meantime, traditional automotive manufacturing is also still active, accounting for around 9.4% of the transaction. Next slide, please. Okay. Transaction data here highlights that Subang Smartpolitan as the area with the largest transaction in 2024, driven by large-scale investment like the BYD factory. But the Greenland also performed well, although it ranked below Subang now. Other industrial areas maintain steady yearly transaction, reflecting that activity in this sector is still continuing. Next slide. Okay. This shows the average industrial land prices. A significant price spike occurred in Tangerang, as you can see in the red line here, primarily because industrial land there is scarce, and most of the remaining land in Tangerang is premium, which explain the price surge. In the overall, prices in several industrial areas has started to adjust, and these fluctuations are largely influenced by the exchange rate changes between the rupiah and the USD. And the industrial zone with consistent sales performance have gradually increased their prices, capitalizing on the opportunity for price adjustment. Some areas are also raising prices to stay competitive, especially if their sales performance is strong and their prices were previously below market level. And that's conclude the industrial market. I'll give it over to Pak Freddy to continue. Thank you.
Yes, thank you, Ferry. Hi, all. My name is Freddy. I'm on behalf of Parifan. Will explain our view about industrial and logistics services. So what we've been experienced for the past few months, especially in Q3 2024, most investors, I think they're in wait and see status there because like office sectors, also they're waiting for the Indonesian presidential elections and inaugurations. And after the third quarter passed, we see more confidence in the market because once the government, the new president, create the new cabinet for the next few years, so they believe more and more investor will invest in Indonesia because of the more stable politics. Yeah. So what we see in the next couple of months, I think more and more Chinese companies will enter Indonesian market because of the tariff war between U.S. and China, and also since Trump won the election for the next president, I think it also helped for investment in Indonesia. Climate become more active. I think because of the Indonesia has more neutral geopolitical standing compared to any other countries in Southeast Asia. Okay, next slide, please. So what we have seen for the last couple of months, most active industries are cosmetics, F&B, and also EV, of course, and electronics, some healthcare products, and petrochemicals. And we will see this company from China, I think, they will create the alternative for them to invest here and then export their products to US or Europe. I think that's what we have seen for the past few months. Yeah. Next slide, please. So what does Indonesia's government do to support Indonesia in industrial estate developers and attract more investors? So I think we all know that most of the industrial estate and infrastructure development is in Java Island. For example, like West Java and Central Java and also East Java. So in the next slide, we also see the government will develop new infrastructure such as South Jakarta Cikampek and also the connection between Jakarta Cikampek Toll Road into Patimban Seaport. So I think these new infrastructure will help the logistics for those industrial players in the Cikarang, Bekasi, and also Subang area to deliver their products. Okay, next slide. So what we know for Patimban, in phase 1, we know that the current Patimban, I think, mostly being used for transporting the vehicle here. And then some of them used for containers. But the government will do the expansion for the next couple of years. I think they're entering the phase 1.2 right now and expected to be completed by 2025. And besides the infrastructure and Patimban Port development, I think we also see in the next slide, the government will also support the SEZ, the special economic zone for various type of industries. So what we know that there will be new 6 SEZ, and also this helps the industrial to be more active. That this SEZ will attract more investors to come to Indonesia, especially for those foreign investors. The new SEZ will be located in 6 locations, 4 in Java Island, and the other 2 is in Kalimantan. Next slide. So what we see the opportunities for the landlord, since there will be increasing in demand for the next coming years. I think the industrial estate developers need to give competitive price to attract more investors and then to draw more tenants here. And we also know that the scarcity of the industrial land supplies for medium to large size, for example, like 5 hectares and above, I think this is the industrial estate developers need to expedite the current development of their supply, so they can grab more opportunities with these foreign investors. And we also will see new industries entering Indonesia, especially from the new investors from outside or from existing companies here in Indonesia. Next slide, please. And for the tenant, the opportunities is, I think this is the right opportunity for them to enter before the price goes up. I think this is the good bargaining power for them, because the land supply, actually the landlords still need sometimes to develop their land, and I think this is the good time for the tenant to bargain with them. And what we see also, some Chinese companies, they also looking for renting the warehouse or a factory so they can immediately start their productions. And then once they establish their company and then understand the market operation, I think they will they will try to find some lands or some factories to purchase, so they can have more established company here. They can have more established factory operation here in Indonesia. So I think that's all our view for industrial and logistic market. Over to you, Mandy.
Thank you, Fred. And Pak Ferry also, thank you. Moving on, we'll delve into the apartment sector and also followed by expatriate housing. Pak Ferry Salanto will provide the market updates for the apartment sector, as well as the insights, and then followed by Ibu Lenny Sinaga, who will present the insights on the expatriate housing market. Over to you, Pak Ferry and Mbak Lenny.
Okay, thanks again, Bu Anti. And for this residential section, here I will talk not only about the market update, but also the insight and opportunity, as Bu Anti mentioned, in the residential property, particularly the apartment. And on the other hand, my colleague Ibu Lenny will give you an overview on the expat housing market after this. So here we have a chart here showing the annual supply of apartment in Jakarta. I noticed that there are there is question about the apartment and other property sector in Surabaya, and I can answer you here. You can download it from our website, because we also cover Surabaya market in the same sector like in Jakarta. Okay. Now we focus on the residential high-rise residential apartment. In this slide, we see that the apartment supply growth won't be too aggressive over the next 2 years. And this is mainly because there are not many new projects being launched, and the completion timeline for existing project up to 2025 and 2026 are often subject to change, although this adjustment tend to be minor. But currently, Jakarta has around 226,000 apartment units, and this includes strata title apartment for sale only, but exclude the service apartment. And in the third quarter, 2 new projects were launched, i.e. LRT City Tebet and Suites Casablanca. And there will be additional 9 projects with a total of 4,756 units, which is still under construction and expected to be complete by the end of this year. Next slide, please. Okay. Now, on the policy side, tax incentive like PPN DTP or VAT subsidy remain available until the end of December this year. Stable interest rates are another positive factor that can help maintain apartment demand. However, in terms of unit absorption, the performance is still underwhelming. By September 2024, now only 486 units apartment were sold, which is significantly lower compared to the previous years. And this reflects that the considerable challenges the apartment market is currently facing. On a brighter note, we are starting to see investor buyers returning to the market, particularly for new projects. And this is expected to boost the apartment market's performance in the next year, supported by developers who are becoming more active in attracting buyers through promotion and incentive. Next slide, please. Okay, and this is new service apartment project. And the occupancy and rental trend here are also reflected that the overall occupancy and rental trend of the similar to the overall apartment, the whole apartment market. And data shows here that occupancy rates have been relatively stable from 2021 to 23, which a slight increase. This trend is also reflected in rental rates, as you can see below, which has shown an annual growth up to 2024. And higher occupancy rate and rental growth provide hopes for better returns compared to the previous years. And this could actually act as a catalyst for investors to re-enter the strata title apartment market. Next slide, please. Okay, now these are the key insights for the apartment market. First is the many developers are now focusing more on the end users rather than investor, and this can be seen in the strategic concept being offered, especially for the mid to upper market segment. And the next one is that ready stock apartment, or we call it completed units, are more attractive are more attractive than those that are still under construction. The absorption for ready stock units has been consistently strong in the recent years. And then we also see that incentives like PPN DTP are still crucial, especially for unit prices under 2 billion. And this incentive help attract buyers in this segment. Although you won't anticipate that this will have great impact as in the landed houses sector. And then the next one, that the market is also benefiting from the policies that make it easier for foreign national to own property in Indonesia. And then we also see that the secondary units currently offer discount up to 30%, which poses a significant challenge for developers launching new projects. Next one. Okay, now the opportunities. Here are some of the apartment projects located alongside the LRT road. which we want to highlight, including those completed and under construction. Okay, next, move to the next slide, please. Okay, we see great potential for apartment located alongside the LRT line, although most of these projects are still under construction. And as shown in this chart, some projects are currently being built, as you can, in the previous chart, and most of them won't be complete until a few years from now. Even though the prices are quite affordable, ranging from 500 million to 1 billion rupiah per unit, demand for this project has not reached the expected level. And this could be because most of the buyer see that these apartments are as an investment opportunity rather than a place to live. So many buyers are investors hoping to rent out the units and attract tenants who need direct access to public transportation. And around 50%, as you can see in the chart in the left side, 53% of buyers fall into investor category. And as price growth, while it's not very significant, apartment prices along the LRT line have increased about 1.2% per year, which is low, but this is already higher compared to the apartment outside the LRT line, which prices increase is only about 0.3% per year. And the key point here is that the developer needs to continue with the construction progress and improve facility offered, because construction progress is always the issue for most of the buyer. And this is crucial to rebuild the consumer confidence. The less than optimal sales are largely due to the lack of consumer trust, which is affected by delays in the project completion schedule. Next slide, please. Now, what are the opportunities for developer? So based on our analysis, we recommend that developer focus on utilizing ready stock apartment, as this unit can take advantage of PPN-DTP or VAT subsidy facilities. Typically, the absorption rate for ready stock unit is higher than for units under construction at this moment. And developers should focus on segments which relatively affordable prices, such as studio units, prices below 2 billion IDR, and this price range offer an opportunity to leverage the PPN-DTP incentive, making the units even more attractive to buyer. We also believe that the TOD is still a promising opportunity. Apartment near public transportation facilities such as LRT or MRT or even the railway station offer advantages in terms of accessibility and commuting time for residents. And given that the prices of these apartments are already rising, if the market improve further, price appreciation for this unit will likely to happen faster compared to apartment located outside the transportation hubs. And another area that needs optimization is the secondary unit market. With the secondary units price lower than new ones, I think developer could offer buyback or renovation program to increase their competitiveness against older units. And lastly, offering flexible payment scheme such as installment plans with added interest. That would be a great innovation for developer. And also providing additional incentive for buyer could also act as a catalyst to boost apartment sales in a market that is currently under pressure right now. And the next slide, we are talking about the opportunity for buyer. So we think that buyer can take advantage of the current market because prices are very competitive right now. And we could say that this is a time to buy because the price to income ratio is more affordable and apartment prices have been relatively stable without much increase. And this makes it a good time to seize the opportunity as long as buyers are selective in choosing projects that offer the best potential returns. And of course, buyers should still take advantage of tax incentive, even though the time left to use this facility is quite limited. But we hope that the government might continue or introduce new policy that could offer similar incentive and making it easier for buyer to purchase apartments. Also, buyers can look at the potential for appreciation in the property values, especially in strategic location, and buying apartment close to public transport or in growing area like East Jakarta could also offer future value gains. And the key right now is to ensure that the developer are committed to completing their project. So that should be the key. And with many apartments being sold as significant discount, this also give buyer the chance to get units in premium location at lower prices. And that's conclude my presentation for residential. I'll give it over to Ibu Lenny for talking about the expected market. Thank you.
Thank you, Pak Ferry. Selamat sore, Bapak Ibu. Okay, let's focus on expatriate housing. I have some insights here. As you know that the expatriate housing market since last year until now, 2024 is the performance is positive, steady. So in 2024, even that there's the president election, it doesn't impact with the new government and development of IKN doesn't impact the expatriate housing market, that's very good. Next slide, please. Okay. Another insights here, I want to talk about that the multinational company that since 2 years, they keep bringing that the new expats because that the projects back to normal. And then we've seen that they're decided to bring that more single expatriates rather than with the family. So in this time in 2024 until that, I think next year, there will be the same, so that they're more focused to the single expatriates. So therefore, the companies, they prefer to put their expatriates in service apartments. Why? The reason is because they're it's like already full service, fully furnished, everything's complete, included. Utilities, so there's no extra cost, which is when you rent at the landed housing, there's the other costs. So in here, we will see that in 2025, that will be the same. Okay, next slide, please. Let's talk about the rental rates. We've seen that the landlords very confident since the last year in the market. We experienced that the rental rates that slightly increased. And because the landlord is very confident that the leasing performance is good, and then the expats back to normal, and then the rental rates that we'll see that increasing until next year. So in 2025, that will be slightly increased, but about the lease period, that will be the same. So for the apartment, unserviced apartment, minimum 1 year lease, and then landed housing, that minimum 2 years, and it all has to be full payment in advance. Well, the service apartment, we can use that the daily rates for short term or long term, that 1 year. So we will see that the landlords very confident about the leasing until next year. Next slide, please. Okay, the opportunities here. So we've seen that the opportunities that for the landlord that who has the properties that they're very confident that the properties that will continue to be leased by the expats, because they know there's still business, the multinationals still running the business in Jakarta, so the investment that still going on, so that's why that this is the opportunities for the landlord. Either you have the apartment or the landed houses. I think that you need to upgrade your properties, or for the management. I mean that for the service apartment, you have to think about how to add give the additional service, or that the benefits to your guests, to your clients. And therefore, since that the expatriates will coming that with a single, and then the multinational company will focus in the service apartments. So this is that the opportunities for the landlord to offer that attractive rental rates, like to give the promotion or to give the better service, that the extra service to the clients, So service apartments, single expat, still coming more. We're expecting in 2025. Okay, so that's all from residential services. If you have any inquiries or you need more info or has any question, please feel free to contact me. My team and I will be happy to assist you. Thank you.
Thank
Back to
you,
you,
Mbak
Auntie.
Lenny. Yes, thank you, Mbak Lenny, and thank you, Pak Ferry. So for our final session, we will have the hospitality services. Pak Satria will provide insights and opportunities, and Pak Ferry will start with the market updates on hospitality. Pak Ferry and Pak Satria, it's all yours.
Okay, thank you, Ibu Anti. And let's move to the final session before I give the session to Pak Satria to dive into the trends and detail further. Okay, on this slide, we have two charts. The one on the left shows hotel occupancy in Jakarta, while the one on the right shows hotel supply in Bali. And if we look at the annual supply, both Jakarta and Bali recorded negative figures in 2021 and 22 during the pandemic. And this was due to the closure of several hotels that ceased operations. Starting from 2023 through 24, supply has gradually recovered, especially in Jakarta. In Bali, we see a negative supply in the third quarter of 2024, and this is mainly because of the ongoing renovation of Hotel Mulia Bali and also the rebranding of Mercure Harvest Land. And this explains why the supply figures for Bali appear negative in the charts. Next slide, please. Okay, now this is the performance of Jakarta. This is the hotel performance based on the occupancy rates. There are two charts here. The top chart illustrates the annual occupancy trends for 3, 4, and 5-star hotel in Jakarta, while the bottom chart shows the monthly occupancy trends. And overall, the hotel occupancy started recovering after the pandemic in 2020. From 2022 until now, occupancy rate has been stable and even improved throughout 2024. And if you look at the monthly trends, there is usually a dip in occupancy during March and April due to the Ramadan and Idul Fitri holiday, which reduce business activity in hotels. After that, the occupancy tend to stabilize until December, when it typically dips again. Next slide, please. Now, Bali, in terms of occupancy or average occupancy rate here, the trend is quite similar. But interestingly, hotel performance in Bali has significantly improved since 2023, even surpassing pre-pandemic level. And currently, the average occupancy in Bali is around 70 to 80%. And the chart below also highlight occupancy trend in the key tourist area in Bali. And this indicates that hotels occupancy in Bali is more influenced by tourist season rather than specific location. Next slide, please. Okay. Now we look at the data on the ADR or average daily rates. For five-star hotel, as you can see in the chart, room rates dropped significantly during the pandemic, but since early 2023, rates has stabilized and are showing an upward trend. And the same applies to 3 and 4-star hotel as well. And in Jakarta, the rise in ADR is driven by government activities and also corporate events and major events. And this increased demand for hotel at near the event venues. Next slide, please. Okay, now the ADR in Bali over the past few years has returned to pre-pandemic level and is now even higher. Since 2023, hotel rates in Bali have consistently increased as demand continues to recover. And if you look at the number of tourists in the chart below, both domestic and international, from January to July 2024, the arrival has already reached half of the total recorded in last year. And it is expected that this number could match or even exceed last year's figures. And this upward trends in tourist arrival has also boosted occupancy rates and the ADR, especially toward the end of the year during the Christmas and New Year holidays. And overall, this point a positive to a positive outlook for hotel performance in both Bali and Jakarta. And that's conclude my presentation. I'll hand it over to Pak Satria, which will explain you more in details about hotel and hospitality market. Thank you.
Thank you, Pak Ferry. Thank you, Mbak Anti. Hi, everyone. Yeah, as what we have been heard, a few comments on all the sectors. Actually, hospitality sectors are the sectors that supporting most of the division that we have. We seen the traffic that have been reported not only by the industrial or office or also the retails, but the residentials also giving the impacts of what happening in hospitality. We are aware that the occupancy of Jakarta, Bali actually is increasing, and we are enjoying even better than what we've been enjoying before pandemic or pre-pandemic. We are enjoying more than 42% of the MICE business that coming from the government until last month. And also, if we are aware, the activities of MICE, especially in Jakarta and the Greater Jakarta, now is also driven by the other MICE that is coming from the corporate. We see the tourist arrivals in Bali is growing, and you saw our statistic for the half year of 2024 actually is intending to growth, but we need to be aware that the growth of the foreign tourists in Indonesia right now is not only growth in Bali, Jakarta, and Batam, but we are now having a few more ports that is potentially adding our foreign tourists that arriving in Indonesia, such as Labuan Bajo, and also soon Lombok is going to be reopened. We are also aware that the president election, the president inauguration is have been waiting by all sectors and also by the corporation in the whole whole Indonesia, and it shows that this is giving a positive impact, that it will shows to the result of the occupancy of the properties, even though the decision that made is not a new decision, tightening the spending and so on. It also happening in 2014, but we are ready. Actually, the business is ready to face it. On the next slide, please. So this next slide actually also conclude what we have been explained just now, that actually the political issues that happening for the past few months is not affected negatively towards our performance. Yes, it is infected to the few area of hospitality, especially 4-star and 3-star hotel that hit directly by the business of MICE from the government, but our 5 stars and the higher category is not effective at all. But we also happy that actually since 2 years ago, when our president announcing that the new capital city is going to be happening, most of our properties in Indonesia, most of the business in Indonesia have been preparing that we need to switch our market. We need to be ready to see the changes, to face the changes, and by then actually we are actually now ready to make sure that we are going to be access, even though the situation in the political situation and market switching is happening. The next slide. On this slide, the last slide that I have been that I would like to explain is that currently the hospitality business been curated, have been selected, have been sharpened enough to make sure that that the business is no longer the business of feelings only, of the experience only, but every business that now is implemented, every investment, every movement that is happening in the industry actually is toward to the asset management. We are aware that now every investment, every expenses that we put into the operation is no longer put because we want to put it to make sure that the guests happy only, but also we also thinking about the effect of the investment toward our cash flow, our operation, P&L, and also at the end in our return of investment. So this actually have been exercised since we faced the pandemic. We are learning a lot how to control our fixed expenses, especially right now. We never enjoying the expenses of our manpower with by 20% and below, but all of the hotels right now is facing that the expenses for the manpower is getting higher, and even some of the properties are expecting to spend even 30% of their revenue only for the human resources and so on. So we are encourage everybody right now that look, we need to be prepared for that, and make sure that every penny that we are going to spend is going to give us a proper feedback, a proper return, because we cannot just let the expenses grow without any sufficient return. Hope that this a small information that we can share can encourage every one of you, and we wish you a very, very a good festive season in 2024, and we wish to meet you in 2025. Back to you, Mandy.
Thank you, Pak Satria and Pak Ferry. So that concludes the presentation session. We will move to questions and answer session. So as we wrap up this insightful discussion, we encourage you to also engage with our speakers. We have received a few questions from the floor, and we will try to answer your question. And we also see that a few question has been delivered through the registration forms, but due to time constraints, we will limit the questions. And if we don't get to your question during this session, do not worry. We'll send out an email with the answers to your question from our experts. So without further ado, let's open the question and answer session. The first one is coming from Bapak Taufik Sudrajat. This is about the office market, and I think Pak Bagus have agreed to help to answer Pak Taufik question. Pak Bagus, I think Pak Taufik would like to know, as the PPN increased to 12% that Pak Mike have mentioned, and also the Pak President Prabowo has changed the status of Jakarta with the purchasing power law. Logically, this should decrease the possibility for companies to look for new office space. But please explain to us how come the office demand will increase from your point of view, Pak Bagus.
Yeah, thank you for the question, Pak Taufik. Yeah. Number one, Pak, after the COVID, the condition of the office market relationship to the employees, more and more employees actually go back to the office. So during COVID, many companies actually reduce the size of the office space, and then after COVID, especially 2023, many of them expand. So and then this transition is not fully completed, so we expect to see the same 2025 as well, because 2024 we also see that pattern. So because more companies going back to the office, so they need more space, so they expand. And number two, it has been in our statistic, there is a strong correlation between GDP growth and office demand. So we are actually hovering around 5% GDP growth right now, and then our demand actually, if there is no COVID, will be much higher. Now because of COVID, then we don't experience that. So now, if the government could increase above 5%, 6, 7, or 8%, it will definitely brings up the demand for office space. Now, your question is the 12%, 11% VAT to 12% VAT. Now, generally speaking, the occupancy cost of many companies only represent 10 to 15% of the overall cost of the company, overall expense. So the 12% or 13% increase on the VAT, it does not contribute much to the total overall expense of the company. Now, if the economic stability, which is already good, right? Political uncertainty is already addressed. Now everything seems going into the right direction. We expect a lot of companies will perform in their business, meaning sales revenue increase, income revenue increase. So those increase on the tax or the biaya balik nama for cars will not impact so much on the whole occupancy expense, as I mentioned early on. So generally speaking, we expect to see what the government is planning to target GDP growth increase is happening. And then we already start seeing actually a lot of companies that are in energy business, that are in the oil sectors, that are in the mining companies, that has been on hold their business expansion due to the the changes of the president. Now they continue because we are handling all those companies right now, and they have given us the green light that they will need office space next year. So that's the answer to the question. So hopefully this the last one that you mentioned, the purchasing power, right? So the purchasing power, hopefully it will be addressed soon, because the government's trying to clean up the country. So once the GDP growth increase to 6, 7, 8%, so we hope to see unemployment rate reduce. So purchasing power come back into improve basically. So
Thank you.
hopefully that explain the why I believe in 2025 the demand for office space will increase.
Yes. Thank you, Pak. Following Pak Taufik question, there's also a question from Bapak Ahmad Maki. In terms of the Trump effect, which we predict shall translate to industrial assets inquiries, how do these tailwinds resonate with the office sector market, Pak Bagus? And is there any plan from the government to issue any office moratorium to maintain market health? Because to democratizing the office market into the rate in universe, the occupancy should be healthy in the first place. What do you think, Pak?
Yes. Thank you for the question, Pak Ahmad. Right now, we forecast the Trump effect, especially on the China and US tariffs issue. And our relationship with China is already good. So we hope to see China moving their factories, to Indonesia. And when that happens, will be more companies from China that will need office space here in Jakarta. And we hope that will help the stabilization, the balance between supply and demand, and also addressing to the question that Pak Sudrajat asking also early on, right? So that will boost up the demand. Now, in terms of the moratorium of office, at this time, actually, without having any moratorium, we don't see any new development of office building. And then the reason is very clear, because it's just currently there is oversupply. So what you see actually in the slide that Pak Ferry has shared is the buildings that is already ongoing, the construction is already ongoing, and it's been delayed because of COVID. And they continue on, so it will be completed and then enter into the market in 2026 or 2027. And one of those buildings that actually have decided convert that address that the supply of the office space. Actually, we have enough condition of our supply market right now. We don't need to add more office. Now, if GDP growth from 2025 in the next 5 years could increase to 10% to 8%, and that will translate into high demand for office space. So that means the need for better quality office building will still continue, because as you are probably aware, maybe Pak Ahmad, there is still a project planning to be developed or maybe under development already along Sudirman. So that will be continue. And then as long as the investor is long term, if the thinking of the investment is long term, the need of good quality office space will still be there, and then the supply and demand. Supply will be limited without having any moratorium. Supply will be limited, but demand will continue to go up. That's what we see because the GDP growth is anticipated to be 8% or more. So that's the answer to Pak Ahmad overall.
Thank you, Pak Bagus. We hope that it can answer Pak Ahmad questions. And then we'll move to Pak Ferry. We have questions in regard to IKN. This is coming from the audience. Please update regarding the progress of IKN, its market potential, and also its impact on property market in Jakarta. Pak Ferry.
Okay. Thank you, Bu Anti. In answering, who's asking, Bu Anti? Sorry.
There are two questions about IKN. The first one is from Gatia Gumilang from Japan International Consultants for Transportation, and also from GM Asset Management, Lin Sin Soh.
Okay, I try to answer that. But basically, to be honest, we haven't kept up with the latest development regarding the IKN project because we haven't had any direct involvement there. But perhaps some of our colleagues at the Colliers might have update on progress of IKN until today, but maybe that can be answered separately. What we do know based on the news is that President Prabowo has instructed the civil servants or ASN start relocating to IKN next year. And this will have an impact on the civil servant population in Jakarta. What I can discuss here is the potential impact on the Jakarta properties markets once IKN officially becomes the new government center. We've actually prepared a special report on this, which we plan to release tomorrow. But let me give you a brief preview. First, looking at the infrastructure development in Jakarta, it seems that Jakarta will continue to be a business hub, and it's unlikely that Jakarta will lose its status as a major metropolitan area, because with a population of around 32 or 33 million, the potential for development in Jakarta remains very large. So the focus of our report tomorrow will be on the properties that civil servant will leave behind, as many they move to IKN. And for sure, this property will be or may be left vacant. And in the report, we'll examine the impact this could have on various property sectors, including office space, including maybe the potential for hotel or also the residential. So we already seeing an oversupply in the office market, as I mentioned earlier in the presentation. But there's also possibility that this property could be repurposed for other uses, for apartment or for office space. So I won't go into much detail here now, but I encourage everyone present to look out the article we plan to send out tomorrow morning. Yeah, Bu Anti, yeah. And that's a brief overview of what I wanted to share here. Thank you.
Yes, correct. Thank you, Pak Ferry. Yes, correct. We will publish the insights that created by Pak Ferry and team from the research services on IKN and the potential. If you can scan through the QR code in your screen to subscribe to our market reports to ensure that you will receive our future insights and reports. Thank you, Pak Ferry. And moving on to the retail question from the retail sector, Sander. This is from Lin Sin Soh from GM Asset Management. The question is, you mentioned that malls are redeveloped to revitalize the retail space. However, for outside CBD, does it make sense to redevelop mall to mixed use, aka retail and office?
I think it does. Office, I'm not too sure about because as we see in the office market, there's already a lot of oversupply. Although we have seen in the US, for example, where part of shopping malls have been used for co-working and office space. I think in the last webinar we did in the middle of the year, Satria and also myself, we talked about sportainment, for example. Yeah, so we see in Jakarta, in shopping malls or around shopping malls, for example, that sports facilities are being added to shopping malls. So that could be something you could use or implement at your shopping mall to attract a different kind of consumer. I think the overall idea is that there's a change in consumer behavior where we saw that also in the percentage of take-up from F&B and entertainment tenants in several shopping malls, is that over the last 5 to 10 years, the percentage of F&B and entertainment has really grown, right? So where 5 years ago, maybe 20% of a shopping mall space was occupied by F&B tenants, now it's more like 30%. And the same goes for entertainment. So I think the consumer has changed, and it doesn't necessarily go to a shopping mall to only shop, but they're looking for other things to spend their time with their families at those malls and go to playgrounds, go to restaurants, go to the cinema, maybe sporting facilities. So that's something I think I would look into. And then obviously it's depending on the location that you have, it's obviously important to look at the specific consumers in that area and what they are looking for, and you might even ask them, right? Ask the people that live in a certain area and within a certain 5 kilometer radius around your location what they're looking for, and try to implement that.
Okay, that's all, Sander.
Okay, thank you.
Thank you, Sander, and I hope this answer. Last two question will be for industrial. Freddy, there's a question from Ibu Diah Puspitasari. So Ibu Sari,
Yes.
question, which other segment will be affected by the fast development of the industrial sectors?
Regarding other segment, I think as we all know, industrial sectors has played important role, and it will affect some of other sectors such as residential, like service apartments for their expatriate, and also office sector, probably for their office representatives in the SCBD area. Yeah, I think those two sectors will affect more on the growing industrial segment. Yeah. But also, I think for the retail, such as BYD, I think retail also will grow because, for example, BYD will open their dealers, and many other Chinese manufacturers also will open their dealers. So I think that will be also a good opportunity for retail sectors. Yeah, that's all.
Thank you, Freddy.
Yeah.
Last question. This is for Pak Bagus before we conclude our session. Pak Bagus, the explanation about green building in Jakarta is interesting. This is from Oki Rusma. Do you have any information about what kind of green building certification used or acquired by building management in Jakarta?
Yeah, thank you for the questions, Ibu Oki. The one that is commonly used in Jakarta is issued by Green Building Council Indonesia, GBCI. And then the certification itself is ranging from silver, gold, and platinum. So the term they usually use is greenship. So that's the one that is commonly. So it's in Jakarta. So the office is in Jakarta, so easy to interact and connect. And the second one is BCA out of Singapore. BCA Green Mark out of Singapore, also quite common used here in Jakarta. And then the last one is Leeds out of US. LEED certificates out of US is also many buildings which are premium usually have those three or those four. Another one is from Hong Kong. But the one that is easily and manageable to be applied is GBCI from Indonesia. And you may reach out to us and our facility management services company here in Colliers actually help building owners to convert their building and apply for a green building certification.
Yes.
So you could reach out to us if your building would like to do so.
Building owners and also office occupiers, Pak. Both.
Yes, building owners and office occupiers. Yeah.
Okay, thank you, Pak Bagus. Hope that answers Ibu Oki Ruspa. I think that will conclude our session for today due to time constraint. Don't worry, we already received quite a few questions, and our team here will connect with our experts to help you, and we will answer to your question, and we will email you one by one with the answer to your questions. Give us probably a few days to gather all the information and answer, and then to email it to your email that you register in the registration form. So thank you for all for joining us today, all of the Colliers panelists, as well as all of the attendees. And as we wrap up this insightful webinar, here are a few key points. We will send you a link to access both the recorded version of this webinar and the presentation slides tomorrow. Please check your inbox, and if you do not receive any in the next 2 days, do not worry. Just reach out to Sandra, the one that admit you to this webinar, and we will help you to get the both recorded version and the presentation slides. If you have any further question or any additional information needed, feel free to reach out to us via email. And your feedback is very important to us. We have a brief survey ready, and we would greatly appreciate if you could take a moment to share your thoughts. Your insights will help us improve future webinars. So we still have these QR codes ready. If you need to subscribe or you need to connect with our experts, you just need to scan these. And thank you once again for your active participation. We look forward to connecting with you again soon. Bye-bye, everyone.